In this week's video, with the trade war still taking center stage, we'll run through specific bull and bear scenarios. Let's kick off the video with the million-dollar question. Have we flipped to a bearish trend? We've got a ton of important material to cover in this week's video, so we're going to be moving very, very rapidly. As we have noted on several occasions, prior to the peak in the S&P 500 index in late January 2018, we were unequivocally and unquestionably in a strong bullish trend. And we know there are three basic steps for a trend change. Step number one, you have to break a trend line, which is exactly what happened in early February of this year. And we know if we're going to flip from a bullish trend over to a bearish trend, we have to make a lower high. We've done that. This is a discernible lower high here relative to this high here. And the February low of 25.32 and this high, intraday high of 28.01 serve as our somewhat de facto trading range in here. Why do we call it a trading range? Prices have stayed between 25.32 and 28.01 since entering this box here in early February of this year. Now remember here, we are unequivocally, it's not even debatable, in a strong bullish trend at this point. And if we fast forward to the present day, or April 6th, we have not even completed step three for a simple trend change. We have to make a discernible lower low relative to these lows over here. We have not done that as of Friday's close on either an intraday basis nor a closing basis. That doesn't mean we're not going to complete step three, but we have not completed step three yet. And as we noted on short takes, we know with 100% certainty if a new bear market has started and a new downtrend has started, we will absolutely, positively, at some point, close below 25.32 and will stay below 25.32 if a downtrend is to take place in this direction. That has not happened yet as of the close on Friday, April 6th. And as we noted several weeks ago, new information from a price perspective comes from a sustained push above the top of the range or a sustained push below the lower end of the range. And we know from our bullet points, we also learn very little as price whipsaws up and down between 25.32 and 28.01. If you'd like to see some more visuals about trend changes and the three steps, you can Google this title here and find this July 2013 article on See It Market. Let's talk a little bit about our game plan under a bearish resolution. On March 21st, 2018, on Short Takes, we noted that if we started to move back toward 25.32, that would be a high anxiety event. Therefore, the fact that trading was difficult and uncomfortable during the session on April 6, 2018 is really not surprising at all. In fact, it's following the post-plunge script that we've been talking about literally for weeks now. And it will also be a high anxiety event if the market wants to drop below 25.32, and that's to be determined. If that happens, it will be very, very uncomfortable. And as we've noted in the past, there's a reason why we've used the term sustained move. It is not uncommon at all. In fact, we will cover an historical example later in the video. To see a push below the bottom of the range for a very short period of time, and then you have what's known as a failed breakdown. Everybody's stop loss orders execute in this area here. We know everyone's watching the bottom of this range in some shape, form, or fashion, and we know there's a good chance a ton of selling pressure will come in on this side of the orange box if we get there. And that's exactly how you get failed breakdowns. Everybody decides to sell in the same area. The selling pressure dries up relative to buying conviction, and you can get a sharp reversal. That is not a prediction in any shape, form, or fashion. We can also get a sustained break in this direction. So the longer we stay below 25.32 and the further we move away from 25.32, the more relevant it becomes. Dropping below 25.32 intraday for a few hours is not particularly meaningful, which means if that happens, we're going to have to try to be patient. Closing below 25.32 for one day is not particularly meaningful. You can find plenty of cases in history where that happens and the market bounces back soon thereafter. Again, not a prediction. We're simply running through scenarios. Again, the longer we stay below it and the further we move away from it, the more meaningful it becomes. On Friday, April 6th, we know that we were in line with the evidence and no action was necessary. We have seen what the model numbers look like when we get down in this area here, and not surprising, we are near an inflection point. It typically works that way. The trend strength model typically gets into somewhat of a 50-50 range when you look at all of the parameters, including shorter term parameters in this range here. As we sit up here, looking at all the evidence, we're in the 60s right now. But if we look at the long-term pieces of that, we're still in the high 80s or 90s, telling us that the long-term trend is still very, very strong. And in that case, the model defers to the long-term trend, giving a correction a chance to run its course. That was not chosen arbitrarily. That's what historical market data says is best to do, and that's what produces the best results. And it passes the common sense test. When you have strong trends and strong math and you get some type of dislocation, typically you eventually go on to make a higher high, and thus patience is rewarded. That scenario will start to diminish if we break 25.32, and the longer we stay below it, the lower the probability that we're going to go up and make a higher high. Therefore, if we get into this area here, and if we stay there for any length of time, the odds are extremely high that the math is going to tell us that we're going to reduce our equity allocation. The longer we stay below it and the further we move away, we will most likely have to cut in relatively big chunks in here. It's also possible that we could move down here, cut once, and the market could pop right back up. That's why we'll be making incremental cuts based on price action in this area here if we get there. Right now, if we take all of the emotion and throw it out the window, we have not even completed step 3 for a simple trend change. This is a higher low relative to this low here. This closing low, I believe, is fractionally higher than this closing low. And even if this was fractionally lower, that's still not a meaningful and sustained lower low. And the same would be the case if we break into this area for a short period of time. That doesn't tell us that we have a trend change. Sustained is a key word if we break in this area here. No predictions, no forecasts. We're open to all outcomes, and we have a very specific game plan. We know exactly how we're going to handle it if price gets into this area here and moves in this direction here, which is absolutely, positively possible. It will be 100% dependent on the news cycle in the next 2 to 3 weeks. If it's unfavorable, we'll probably move in this direction. If some good news comes out, we'll probably move in this direction. We'll continue to take it day by day. Some other topics that we're going to touch on in the balance of this video. How many boxes have been checked on a fundamental bear market checklist? Number 3, the last 10 times the S&P 500 dropped below its 200-day moving average, how did stocks perform in the next year? Number 4, we'll describe 2 key market areas that investors and traders typically greatly underestimate. And we also will be covering a handful of helpful big picture charts. So let's skip down to topic number 4. S&P 500 index, calendar year 1991. If I was a short-term trader and I was using the 8-day and the 12-day exponential moving averages, and I were trying to navigate between point A and point B, we can see this is absolutely positively whipsaw city in here, telling us for our time frame and our purposes, the EMA 8 and the EMA 12 are not particularly useful. They can be very, very useful for a short-term trader. Under our approach, we're trying to navigate from a point A to a point B. And we put price on the graph. This does not look particularly easy to get from point A to point B in 1991. If we take volatility out of the equation and the stock market just moved up a little bit every day, it would be very, very easy to capture this 26.81% gain that took place in calendar year 1991. In early April 2018, this orange box might look familiar. Volatility is not particularly abnormal. It can be very, very difficult to navigate between a point A and a point B. This is a hair-pulling, head-slapping trading range that lasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, roughly 11 months. One of the takeaways can be summed up in this quote from Market Wizards. The moral of the story is that the penalty for being out of the market on the wrong days is severe. And human nature being what it is, those are exactly the days that most people are likely to be out of the market. Almost all of the gains for calendar year 1991 occurred in very short spurts, from this point to this point, and from this point to this point. Human nature being what it is, those are exactly the days that most people are likely to be out of the market. Big plunge here. A lot of fear. We're dropping very rapidly to start the year. I need to protect capital and manage risk. Right after that, a huge move in the market. Here, we've been going sideways for several months, which is incredibly frustrating. Whipsaws all over the place. If you drew a simple trend line dating back to May, you can see that we violated the trend line clearly. We've stayed above that trend line for several months. We violated it here. Human nature being what it is, those are exactly the days that most people are likely to be out of the market. Right after that, in a very short period of time, the market makes a big move. I think most of us would be thrilled with a 26% gain in any calendar year. This anecdotal example, which is not particularly abnormal, most years are difficult, tells us that our common missteps, watching things too closely and being fearful, typically make it extremely difficult to navigate between a point A and a point B. Helping us illustrate the two key areas that traders and investors typically greatly underestimate in the markets. Number one, markets are frustrating, very volatile, and difficult. Number two, they have a tendency to greatly underestimate the power and strength of the primary trend. 1991, a very, very difficult year, but it was possible to capture a very satisfying gain between point A and point B. Volatility is not abnormal at all. Actually, low volatility is relatively rare. A 1995 and a 2017 are the rare years. This is more typical. Now let's look at another example. 1998. In July of 1998, we have a very strong trend here, well above the 200-day moving average, 22% gain year to date. Why do we always talk about keeping a flexible, unbiased, and open mind about what happens next? Because we know that human beings like to extrapolate. So human beings take this chart and they assume that price is going to finish the year out like this, and they just take the moving average. We all do it, and we have a tendency to say this is what it's going to look like. What happened next? The tendency to extrapolate was not particularly helpful, and a lot of bad things happened next. Number one, this is a lot of support in here. We broke that on both ends. price dropped below an upward sloping 200-day moving average, and price failed to recapture the box or the 200-day moving average. And then price, on an intraday basis, went on to make a lower low. And to top all of that off, after having a 22% gain year to date here, price went negative for the calendar year. A lot of bad things happening on this chart. And human beings like to extrapolate. We know what's going to happen next when we look at this. The 200-day moving average is flattening out. It's going to roll over, and we've got a new downtrend in place, and price is going to move in this direction. A lot of scary looking things on this chart. There's a reason why we always say keep a flexible, unbiased, and open mind and take it day by day. What happened next? Did the 200-day moving average roll over? And did the downtrend continue, and did price plummet? And before we click through and answer that, this quote is going to apply once again. Human nature being what it is, those are exactly the days that most people are likely to be out of the market. Looks very, very logical to exit here. Notice, we make a lower low here intraday, and we come back up and close right around here. So if we sold when we broke the bottom of the box, that wouldn't have worked out particularly well because the market rallied hard and the primary trend continued. In fact, rather than this being a logical place to exit, this is point A, the market didn't fall in this direction. It gained 33% to this high here in December of 1998. And while we had a very, very difficult market, not easy to navigate from point A to point B, and despite all of the bearish evidence, the full year return with the primary trend between point A and point B was almost 27%. 1998 also helps us illustrate our 2 points. Markets are frustrating, volatile, and difficult. And traders and investors typically underestimate point 1, and they typically underestimate the power of the primary trend. We can't logically attack any problem if we don't understand the problem and respect the difficulty of the problem. The basic moral of the story here is, are markets easy? No. Markets are incredibly difficult, which is exactly why it can be extremely powerful to simplify by focusing on the primary trend and long-term probabilities. Just to give ourselves some type of mathematical reference point, and notice a mathematical reference point is important. It has nothing to do with opinions or forecasts. These are our simple, generic, and for illustrative purposes only 100 all the way out to the 290-day. Roll over look. Here's the close, the exact same moving averages when the S&P 500 was down 58 points on April 6th. We can see the longer-term trends right now really don't look anything like this post-peak period here in calendar year 2007. And we just looked at this 1998 example that has a lot of similarities to the present day, including breaking the lower end of the box. So this would be the equivalent of breaking 2532 intraday in the present day. After this, the market rallied from that low after breaking the bottom of the box, 33%. This is what the market looks like on April 6th. That's 70 calendar days since it peaked in late January of this year. How did the exact same moving averages look 70 days after the peak in 1998? Is the present day trend stronger and in better shape than the trend was 70 days after the peak in 1998? Or is the present day in worse shape, and should we be more concerned? 70 days after the peak. You can see here, this is more alarming in here. There's more deterioration Even here, you can see looking backwards, there's more to be concerned about in here than there is anywhere in here on the 2017-2018 version. 70 days after the peak is noticeably weaker in 1998, and from that scary low in 1998, eventually good things happened. We rallied 33% after breaking out of the box in this case. It's also important to note the model understands that human beings, all of us, that would include yours truly, we have a tendency to extrapolate. We like to extrapolate. We're visual creatures. This is a chart that we showed in last week's video. Human beings will look at this chart and say, the trend is waning. Red is going down. Green is falling now. The slope's coming in. And we'll have a tendency to extrapolate. So when we're here, we know that eventually we're going to get here. As we showed in the 1998 example, that is not a safe assumption, and it wasn't a safe assumption up here either. So it applies to bullish outcomes and bearish outcomes. Extrapolating is dangerous. And the model is built to help us compensate for that. That's why you ask binary questions. You don't say, does it look like blue is going to cross red? There's a binary yes or no answer, and that's incorporated into all of the planning and all of the back testing. That's the beauty of it. There's no guessing about what happens next. Are we allocated properly based on the facts in hand as of the close on April 6th, 2018? Notice that question has nothing to do with what we think these will look like in the future. That's where the flexible, unbiased, and open mind comes in. And heading into next week, it will be important to have that flexible, unbiased, and open mind. We have to be mentally prepared for a sustained break in this direction where we would take incremental action in this area here to reduce our equity exposure. And we also have to be willing to be disciplined and patient near a possible inflection point. The beauty of the facts in the model is we're not dependent upon trying to answer the question, what's going to happen next? Let's check out some of our other bullet points. How many fundamental bear market boxes have been checked? And 3, how did stocks perform the last 10 times the S&P 500 broke below its 200-day moving average? To answer those questions, let's give credit where credit is due. Schaefer's Research, here's their Twitter handle right here. Bloomberg Markets, here's their Twitter handle here. Schaefer's Research took a look back at the last 10 times the S&P 500 breached its 200-day moving average. The average return looking out 1 month, not negative, positive, 2.29%. The average return looking out 3 months, not negative, positive, 6%. 6 months, positive return of 11% on average. A year later, on average, after breaking a key trend line, the average gain was 15%. Bloomberg covered Citi's bear market checklist. Based on their relatively simple approach here, we like a simple approach, they're saying they're checking roughly 2.5 boxes out of the 18, which aligns very nicely with what we're looking at. We always say the charts consider all of the fundamental data. And as we have noted, the present day charts really don't look anything, not even remotely close to the post-peak periods in the year 2000 and the post-peak period in 2007 relative to where risk increased substantially. The fact that the present day on April 6th doesn't look anything like this, not even remotely close, is a reflection of the market's read on the present day fundamentals relative to the fundamentals here. Just as this doesn't look anything like this, and this doesn't look anything like this, Citi draws the same conclusions. The 18 fundamental factors that they're looking at don't look anything like March of 2000, and they really don't look anything like October of 2007. You can find the entire Bloomberg article by Googling this title here. There are so many examples of bullish years that are highly volatile and difficult. There's no way we could cover them all in one weekly video. In the present day, the volatility always feels abnormal. But as we have shown in past videos, in similar markets, similar to 2017, similar to 2018, similar markets that featured a big gain from point A to point B, 228%, was volatility rare? Absolutely, positively, no. The average red day, a loss of 0.74%, telling us there are numerous red days between point A and point B that featured daily losses quite a bit greater than the average of 0.74. We are getting closer to a mathematical inflection point based on our approach and our time frame. And as we have covered in the past, discerning between volatility to ignore and volatility to respect can significantly impact the quality of our life. If I start with $1 million in the bullish cases, it looks nice. If I try to buy and hold forever, it can be very, very painful. My $1 million can turn into $430,000, and that is not a hypothetical scenario, which is why it is extremely important that if we get a sustained break of 25.32 and the math calls for action, that we make no assumptions about anything. When it comes time to take action and protect capital, we are going to take action and protect capital. When it's time to sit tight near an inflection point and be patient and disciplined and ignore the noise, we are going to be patient and disciplined and ignore the noise. One of the reasons why human psychology is so important in the markets is we all tend to make the same mistakes over and over. We are all susceptible to making them, including yours truly. Therefore, if price decides to move into this area here, even if it's for a short period of time, it is going to be a high anxiety event for most market participants, and that is understandable. And at that point, we should remain flexible and open-minded to all outcomes, really, really bad outcomes, and much better than expected outcomes. Why? Human beings tend to overestimate the likelihood of improbable but highly emotional events, as the intensity of emotions make us recall something more vividly. The type of highly emotional events that we remember when we're inside of this box are things like the 1987 crash, 2008 when we were in a primary downtrend, 2001 when we were in a primary downtrend. Those painful memories have a tendency to have us overweight or overestimate the likelihood of really bad things happening. If really, really bad things are going to happen, and that's possible, we know with 100% certainty we are going to drop below 25.32 and we are going to stay below 25.32 for a sustained period of time. If that doesn't happen, then it's really not going to be that bad. We need both of those, a break and a sustained break. And as the 1998 example showed us, it's dangerous for us to extrapolate and say we know what's going to happen here. We're in a downtrend, even though we don't even have step 3 yet. We could convince ourselves we're in a downtrend and we know that price is going to move in this direction. Why is that so dangerous? Because when you're near an inflection point, and human nature being what it is, those are exactly the days that most people are likely to be out or get out of the market. And the penalty for being out of the market on the wrong days can be severe. And we've already shown that mathematically and historically. On short takes, S&P 500 returns following the lows in 1955, 1987, 1998, 2011, and 2015. I can pretty much guarantee you, on these dates here, with human nature being what it is, those are exactly the days that most people are most likely to be out of the market. And this is what happened next. That is not a forecast in any shape, form, or fashion. It's just a historical fact. That's what inflection points are. We could get a big move in this direction or a big move in this direction. We don't really have to have a strong opinion at all about that because the data will guide us here. We have a game plan for both outcomes. We're not rooting for one outcome or another. We'll take it day by day, and we're very, very confident that we can execute properly if we maintain maximum flexibility down here. We have to understand it's possible that we're going to cut and have to buy back relatively soon. That's where you have to be willing to push your ego aside and do the right thing. In these environments, the right thing is not always comfortable. Sometimes you're going to sell, the market's going to bounce back. You can either let your ego get in the way or you can recognize that the data is improving and adjust as needed. And that's where our flow chart comes into play. Success when you're running a probability model is executing properly. If you execute properly, eventually the hard data will get you in the right place. Regardless of what happens over the next 2 to 3 weeks, the long-term war will not be won or lost based on whether we break below that box or stay above the box. Case in point, as an historical example, prior to Black Monday, primary trend, big gains, 229% from point A to point B. You get one of the biggest dislocations in stock market history. If you maintained your composure after Black Monday and executed properly, there was plenty of time to recoup those losses and make very substantial gains. Once the primary trend reasserted itself after Black Monday, the S&P 500 gained an additional 582%. Conversely, bear market examples, such as the peak in 2008, tell us we cannot blindly assume anything. And once again, that's where the flow chart and the discipline comes into play. We know the primary trend was up prior to the peak. April 6th, 2018, we still have a very favorable long-term setup for tech stocks. April 5th, 2018, we still have a very favorable setup for technology stocks versus bonds. We still have a very favorable long-term setup for global equities. We still have a very favorable long-term setup for industrial stocks relative to long-term treasury bonds. We still have evidence in hand that tells us stocks could rally for many years to come. This breakout here holding fine as of April 5th, 2018, not even close to losing it. We still, as of April 5th, 2018, have a constructive and very long-term breakout that looks way better than the peak in the dot-com period and way better than the peak before the financial crisis. The present day, April 5th, 2018, for the average stock really doesn't look anything like price being rejected here, price being rejected here. Now we have a bullish breakout from a very long-term period of consolidation. Like anything else, if we move back below the green line, then that would become meaningful. We have not done that yet. The annual signals that we've been covering, April 6, 2018, We consolidate for a long period of time. We get 1, 2, 3 bullish signals. Good things happen for several years. We consolidate for a long period of time. Good things happen, 3 of them. 1, 2, 3. Telling us to keep an open mind about better than expected outcomes for a long-term perspective, regardless of how things play out relative to the trading range or the consolidation box. If we execute properly over a long period of time, the probabilities and the law of large numbers will be in our favor. As we often do, we will close with several apropos quotes to the present day. The first one comes from a 69-year German psychologist who has been studying how humans make decisions for most of his career. He was asked in this article, which you can find by Googling this title, if you were to take all of your knowledge, spanning all of your papers, all of your research, and all of your talks, and all of your studies, what conclusion would you draw, or what advice would you have for us? It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.